Well, hi everyone. I'm coming to you from Boston this week, but it's a different location for me. But I thought it was important just to check in now that we had last week's FOMC meeting. As expected, we saw the Federal Reserve cut rates by 25 basis points last week. So no surprise there. But what I thought was interesting, as usual, really comes from the comments following the FOMC meeting and the press conference hosted by Fed Chairman Jay Powell, as well as I mentioned last week, this was one of those meetings that occurs 4 times a year where the Fed updates its dot plot and summary of economic projections. And I thought what was interesting there, if we just start with the dot plot, what you're looking at here is what we refer to as this dot plot. And all it is 4 times a year, the 19 members of the FOMC, so you have the 12 regional Fed presidents and the 7 Fed governors, they are asked to provide their expectations or projections of where they expect the Fed funds rate or the short-term policy rate that they set to end in the current year, so the end of 2025, the end of 2026, 27, and then a longer term expectation. The longer term expectation, I don't think anyone's really looking at that as a reliable indicator. I think it's really more important to look at this for what the Fed has in mind, and this is all anonymous, but I think it's interesting just because it shows where those that are in charge of setting interest rate policy expect policy rates to go in the future. And so obviously things can change, but one of the big takeaways last week is that this is a Federal Reserve that seems as lost as a lot of us are. This is not a Federal Reserve with a lot of conviction. So this dot plot that you're looking at, it shows a series of yellow dots, and it's listed in order of year. And so you see, what you see is a lot of dispersion. If we just look in 2025, starting there, what you see is there are 6 dots, actually 7 dots at the top. First, there's 1 dot, and then below that, you see a row of 6 dots. So what that's saying is that 6 members of the FOMC expect no further rate cuts in 2025. They expect policy rates to remain where they are through the end of the year. 1 person actually expects rates to move higher between now and the end of the year. And then the remaining members expect 2 or 3 cuts, or in one case, you see an outlier there at the bottom. There's one individual, he is Stephen Myron, who is on loan to us from the White House. He is the newest Fed governor that was nominated by President Trump. He actually expects numerous cuts between now and the end of the year. So what I take away from this is that this is a Fed that lacks conviction. They are really having a hard time in this current environment. We know that the labor market is softening, but we also know that that inflation is not defeated yet. And so I think that this is an area where we expect things to be a little bit choppy here. We're waiting for more data. It appears the Fed is as well. Jay Powell in his press conference talked about the fact that we are facing 2-sided risks right now. One risk being that the Fed doesn't cut rates as they did last week, and the labor market actually gets a little bit worse and they fall behind the curve. The other risk is obviously the other side of their mandate. We talked about their dual mandate last week. And so with this risk, it is simply that they ease policy too much, and then we see inflation reignite, and we see inflation actually move higher. We know that it's stalled out around 3%. The risk is that the Fed loosens policy too much, and we see inflation actually start to grind higher. So the Fed is not in an easy job right here. If you look out, going back to that dot plot, you look out to 2026, 2027, the median expectation, and you can look at that by using the green line there. The median expectation is for 1 cut next year, 1 cut the following year. Anything can change. We know we are still waiting for the new Fed chair to be nominated by President Trump, because we know that Jay Powell's term ends in May of next year. So I think this is going to be a really interesting environment. For now, we're going to take the data as we get it, just like the Fed will. And as we've been saying, I think it's really easy to get caught up in the idea that now that rates are coming down, view that as a sort of relief for the economy and potential catalyst for the stock market. But that being said, we also are mindful that inflation remains a problem. And so we're not going to get too ahead of ourselves. We may see additional rate cuts in the coming months, but we're also going to be watching that inflation data. And so this is certainly an environment where we're going to remain data dependent, as is the Fed. So I will leave it there for right now. I'll look forward to catching up with everyone next week. But as always, if you have any questions, please feel free to reach out to your advisor. Have a great week.